Hi, afternoon, everyone. Welcome to today's class. Today it's class number 4 of this semester, and once again we are still going to deal with changes in accounting policies. So before I start, I've just shared the slides. Can I get an indication whether you can see the slides or not? You can use the chat there. Just indicate yes or no. Then I'll be able to get a feedback as whether you can hear me clearly, and also you can see the slides that I've just shared. All right, thank you. I see that I got an indication that yes, we can see the slides. So let's start with some admin or announcement. I've received a question today. When are we writing the test? Are we writing the test on Wednesday? The answer is no. The test or assessment for Financial Accounting 3 is not going to be written this week. We'll let you know in time when are you going to write the test or the assessment. So that is out of the way. The test or the assessment for Financial Accounting 3 is not going to be written this week. Coming to the class recordings, as I've indicated that today is our 4th class for this semester, so meaning that already we had class 1 until class 3. The recordings are ready. I've sent them through the class reps. So the link to the recordings, you can get them from the class reps for recording 1 until recording number 3. After the class for this recording, I'll also upload it and send the link as well through the class rep. The next announcement or admin is that if you have any question during this class session, you're more than welcome to use the chat. Any question, if you want me to repeat anything you don't understand or just a question, please, you're more than welcome to use the chat. You're more than welcome to use the chat. So on my tutor, for those of you who normally visit my tutor, you will realize that we have uploaded the videos regarding these change in accounting policies, explaining the principles, as well as the question banks. So over and above the recordings of the classes, if you're not sure of any principles regarding these change in accounting policies, estimated errors, you're more than welcome to go to my tutor. You can download it, you can view it there as well. So there are videos on my tutor, there are recordings as well that I've sent the link through the class rep. So please visit it, go listen to the principles. If you're not sure about it, use the question bank that we've given you to practice so that you will be ready for the test or the assessment that you're going to write. As I've indicated, the test and the assessment will let you know when you're going to write it, but one thing for sure is that you're not going to write this week. All right, having said that, let's start with the business of the day. We've been doing this topic for quite a while now. Class number 4, we're still dealing with changes in accounting policy, estimate, and errors. And the reason being that this topic, we can break it down into 3 components, which the first one is the change in accounting policies. We dealt with that in class number 1 and class number 2. And the other component part of this topic is changes in estimate. We dealt with that in class number 3. Today, in class number 4, we're going to deal with errors. So what we're going to go through, we'll go through the principles and we'll look at the exercise. The exercise that I've just picked up for today, it was one of the tests that was written last year. So the standard for the assessment of the test will be more or less the same that you're going to see here today, All right, let's start with it. So what are the expectations with regard to this topic, and specifically when it comes to errors? So at the end, you should be able to prepare the statement of profit and loss and other comprehensive income. You should also be able to prepare the statement of changes in equity, and you should be able to prepare and disclose correction of error note. So in accounting, presentation, disclosure, it's very important. I can't stress that enough. So disclosure and the presentation is very important in accounting. I hope you know by now, this is level 3. So if I take financial statement of any company, and I just want to see how much income they made, you know that I'll go to the statement of profit and loss and other comprehensive income. I'll be able to see how much revenue was generated. If I want to see dividends that was paid or declared, I'll go to the statement of changes in equity or statement of financial position. I'll be able to see that. If I want to see how much is the value of the assets of certain company, I can go to the statement of financial position and I'll see it. And over and above that, everything that will be material on the financial statement will have a note. So it is very important that you know how to disclose a note. So in this case, for this topic, when there's an error and the error has been identified and is corrected, such information must be disclosed in the note. Such information must be disclosed in the note. All right, so let us look at this last part. As I've indicated, errors. What are errors and how do they come about? So if you look at International Accounting Standard number 8, it indicates on the definition that errors are omission or misstatement, which is previously reported in the financial statement, right? So what can happen here is, if the company has an accountant who's not experienced, that person might make mistakes. It can happen. Or the company could have an experienced accountant, but that accountant could miss some of the information, and as such, when they prepare the financial statements, then there will be omission. So when those mistakes are identified in accounting, we call it errors, and those errors need to be rectified. So that's what we're going to look at here. So you will see when we go to the actual example, information will be given to us. When we read that information, we should be able to pick it up. What is the issue? What was the error? What happened? If you identify that, it's half the problem solved. You will see when you do the actual exercise in no time after these slides of these principles. So once you identify, let's say, for example, the company purchased a motor vehicle. You know, a motor vehicle is an asset. When they purchase it, the accountant, when they were processing the transactions, they include that asset as an expense incurred. Then there's a mistake there, because when you go to the financial statement, you won't see that vehicle which they purchased. So the simplest journals that needs to be passed is, when a motor vehicle is bought in cash, you must debit your asset, which is motor vehicle, and credit bank. So if the accountant goes and debit expenses and credit bank, then there's an error there. There's a mistake there that we need to fix. That is just a classic example. So if we get to a situation like that, we as the accountant, we must be able to solve that error. So this statement of International Accounting Standard number 8, changes in accounting policies, changes in accounting estimate, and correction of prior period errors. It's all about that. So we're dealing with the errors now. If we can identify the error, we should be able to see how to solve it, which period is it affecting, and what is the impact on the overall financial statement. That's what we're going to do here. And how do we disclose it? On the notes, so that the users of the financial statement, when they read, they'll be able to pick up, say, okay, there was a correction of error. This is how it was corrected. All right, let's proceed. How do we account for errors? This is very important in this topic. Accounting for errors, we must account for it retrospectively. I've explained what retrospectively means. It means that you must go back to the previous financial years and make correction. So, for an example here, if an error is identified in 2019, it means that you must go to 2018 and 2017 and correct the error. In other words, you must go back as far back as possible as the information allows you. Let me repeat this. If an error is identified in 2019, so that means you must go back, go and correct 2018, go and correct 2017. If indeed we still have information for 2016, you must go back and correct it as well. So now the question is, what do you do if information is not available? If information is not available for prior years, then you must indicate as such in the notes that the information is not available. But I can tell you now that information will be given to you. You should be able to just to say information is starting from this period to this period. So which means which period am I going to correct? That's part, disclosure. As I've indicated that everything that you do in accounting, especially when it comes to International Accounting Standard number 8 for errors, you should be able to disclose it. What is that you need to disclose on the note? So this is the summary of the note here. You must disclose the nature of the error. You must disclose the amount of correction. And if it is not possible to disclose anything or to apply retrospective application, then you must indicate that it is not possible. It is not possible to do such. So just to recap here, on the disclosure, there are 3 things that we expect to see. The nature of the error. So here you will be explaining to us what transpires, what happened. What was the issue? As I've indicated with my examples of motor vehicle. So when you purchase a motor vehicle, you go and expense it instead of capitalizing it. You just need to indicate as such that this is what has happened. And now with regard to the amount of correction, we'll see what is the impact on the financial statement. We're going to see that. Lastly, if it is not possible to apply retrospectively, you must indicate as such. Right. Let's look at this example. This example, I've sent it through the class rep. I believe we're going to upload it on my Twitter later on together with a video. So everything from the principles which I was explaining, we should be able to see it in this example. Let me start here with the required. Let me start with the required as usual, because the required will tell us what is that we need to do. Read the information provided to us. Required number 1, they want us to prepare the statement of comprehensive income. Required number 2, statement of changes in equity. And required number 3, they want us to disclose the correction of error, the note. And they are emphasizing that we must show all calculations and also that comparative figures are required. We must show all calculations. So whenever you see that a note say show all calculations, that means that there are marks that have been allocated for calculations. So if you don't show calculations, then you lose all those marks. So I keep on emphasizing that whether they say you must show calculation or don't show calculation, make it a habit of showing calculations when you do accounting. Even if it's a simple calculation like depreciation, you can take a calculator and say 100,000 multiplied by 10%, and you have a depreciation amount. It's very easy for you to be tempted to go and write 10,000. But what happens if when you write, you miss 1 0 there in your solution, so it becomes 1,000. When I look at it, I won't know whether you know how to calculate it. If it's 1,000, you're gonna get it wrong. But if I can trace it where you did the calculations, even if you don't get it on the other side, on the calculation you'll be awarded the mark. So it works to your favor. So if you just do it from a calculator and you write 1,000, it's 0, you're not gonna get anything. So make it a habit of showing calculations, because we can trace it back to say, here's the calculation where you were calculating depreciation. Yeah, we can see that in a final solution, it says 1,000 and depreciation was supposed to be 10,000. So we can award you the mark. That's the difference. All right. Here's the three required: statement of comprehensive income, statement of changes in equity, and a note. And that note must be related to correction of errors. Calculations must be shown. Comparative figures are required. Very important. If you don't understand what are comparative figures, please make sure you understand it. So it just means that if they say comparative figures are required and we're preparing information for 2019, that means 2018 information is required as well. Especially when you do, make sure you show two financial periods, 2019 and 2018. That is very important, because I've seen ignore that only showed 2019. What does that mean? All the marks that are awarded for 2018, you're not gonna get 0. So you shoot yourself in the foot. All right. Let's look at this question. Let's look at this question. Most important information is that this question, they gave us statement of profit and loss and other comprehensive income. So I won't spend much time here. I'll spend much time on the additional information. We'll come back later on and say the additional information that we have, how is going to be impacted by the statement of profit and loss that we have here. How is it going to be impacted by additional information? So, all right, item 1, the issue is, and this is where we'll get to understand what transpired. So I'm going to read this additional information and we'll try and break it down. If we can understand what transpired, what happened, half of our problem is solved. Half of our problem is solved. So let's look at this additional information. Number 1, the information is presented with regard to the motor. Underline motor vehicle, because it is very, very important. So whenever it comes to tell you yourself, what type of vehicle are you dealing with? Is it a delivery motor vehicle. Sometimes they can get to you, it's a delivery vehicle. It is of very important when it comes to accounting and tax. This is where the two integrate. All right, let me let it was has been initiated, excluding, and it further states that this error is material and not yet corrected. The VAT Act stipulates that motor vehicle is inclusive of, well, we gave you the information. So normally, we shouldn't be telling you that what the VAT Act is saying. We will expect you to know, but fortunately, you are given. They say the VAT Act stipulates that when you recognize for vehicle, it must include VAT. Date of purchase of motor vehicle is 1st April 2017. Depreciation has been recorded in the financial statement. Because sometimes they will say inclusive depreciation 31st December 2019, 150,000, residual value 0, useful life 5 years, no apportionment. Very important. Now I keep on getting questions and say, if this useful life, there was no indication whether there's apportionment of. So if the question is silent, you are simple. Useful life, if the question just is, that means that irrespective when the vehicle is bought, we machine wait 5 years, no apportionment. So now, here's the additional information. What is the issue here? What is the issue here? If we identify what is the issue, then, as I've indicated, half of our problem is solved. So it was we are going to correct this error. It is this error. The VAT Act stipulates that the motor vehicle is capitalized inclusive of VAT. Okay, so I think now I know what is the issue. For now, the issue here is when this company bought a motor vehicle and calculate depreciation, the depreciation calculated has VAT was excluded. So if that happens, then that's why I've indicated that when you read this information, you must determine, are you dealing with a motor vehicle or delivery vehicle? Here we're dealing with a motor vehicle. When you buy a motor vehicle, input VAT, you cannot claim from SARS. As such, when you determine the cost of that vehicle, it must include VAT. This is what they're telling us. So what has happened here is whoever was calculating depreciation here excluded VAT. So that's where the error is. and we need to go and correct this error. Me and you are going to correct this error. That's what we're going to do. And this is more or less the type of question you can expect. And it doesn't mean that always you will receive a motor vehicle or a vehicle. You can receive any error. You will see when we go to additional information number 2, there was another error again. Let's look at additional information number 2. We'll go back to number 1, do the calculations, talk about the impact, talk how it's going to impact the statement of profit and loss, statement of changes in equity, and the note. So let's look at additional information number 2. During the 2019 financial year, the current year, it was discovered that an investment purchased in 2019 for 45,000 was incorrectly recorded as operating expenses of 54,000. The error is considered to be material and is not yet corrected. Who's going to correct it? It's me and you. Me and you are going to correct this error. So, but as I've indicated, whenever you are given an error question, understand as to what happened and how we're going to correct it. Think about it. Investment. What is investment? Investment is an asset. So when you make an investment, or when the company purchases investment, it must go and be disclosed in the statement of financial position. In other words, in 2019, because they bought investment here to the value of 45,000, what was supposed to happen is they were supposed to debit investment, which is an asset, and credit bank, because money will be out. That's what was supposed to happen. But what has happened? They're telling us that, but instead of that happening, they recorded that investment as an operating expenses of 54,000. So there's two issues here. Number one is that investment was treated as an expense. Number two was that incorrect amount was also used. So that means that when you go to operating expenses of this company, you will find that there's 54,000 relating to investment, but we know that investment is an asset. So in other words, our operating expenses, it's overstated by 54,000. Let me repeat that. Investment is an asset. Investment must be disclosed on the statement of financial position. Operating expenses, it's an expense, and expenses are reflected on the statement of profit and loss. So they're telling us here that they discover that investment that was supposed to be capitalized is not capitalized, but it has been expensed to the value of 54,000. This error is not yet corrected. It's me and you need to correct it. So I can tell you now that our operating expenses, we're going to reduce them by 54,000, and we take these 54,000 and we increase our investment. We take, so in other words, operating expenses need to be deducted by 54,000. It's going to decrease. And the other portion must go to investment. And this error is material. So there are two errors here. Error number one, motor vehicle. Error number two, investment. We're going to look at these errors separately. We'll also look at how, or what is the impact when we correct them on our financials. I think by now we have an idea. Additional information number three, SARS is going to reopen previous year assessment for correction, and deferred tax is provided on the comprehensive basis. Additional information number four, dividend declared. 2019, 20,000, 2018, 10,000. So whenever you prepare the statement of changes in equity which is required, there's the dividends provided there. Don't lose these easy marks. You just need to know what to disclose it. Additional information number five, the balance of retained earnings amounted to 500,000 on 31st December 2019. I've emphasized this, that when you receive retained earnings, you need to know which balance are you receiving. Here we're receiving the balance at the end. You can receive balance at the opening balances. So by now you should know how to calculate retained earnings. In other words, so if we're given balance at the end, here is what I'm seeing that is at the end. So you should be able to calculate retained earnings balance at the beginning. Tax is at 30%, VAT is 15%. So now, where should we start? I will say let's start with the easy one. Calculating the opening balance of retained earnings. So normally you will be given information to be able for you to calculate that. For example, we're given closing balance of retained earnings as 500,000 in 2019, and we're given dividends as well here. For 2019, I can calculate the opening. If I come here for 2019, I have the total comprehensive income. So how do I calculate my retained earnings? Let me start with retained earnings. Don't worry about the amount for now. Let's worry about this side. In order for you to calculate your retained earnings, so you will need your opening balance, and you will add your profit for the year, and you will less dividends paid, then you'll get the closing balance. In this case, this is what we're given, right? We are given closing balance as 500,000. Here it is. Here it is. It is given. So in other words, we're trying to solve for X. This is given 500,000. We can agree with that. Now let's go to dividends paid. It is given as well, 20,000. Profit for the year, it is given. The missing leg, it's opening balance. So if you do the calculation, it should give you the opening balance as 450,000 for 2019. Opening for 2019, it's closing for 2018. Opening for 2019, it's closing for 2018. We can agree with that. And we perform the same principles that we did with 2019. Dividends is given. Profit, it is given. So I can tell you that our opening balance in 2018 was 320,000. I hope you will get this right. I've seen a lot of students struggling to get the opening or the closing balance. So all this information was given. We needed to calculate the opening balance. Sometimes you can be given opening balance, you needed to calculate the closing balance. Depends on the information provided. But dividends and profit, most of the time it will be provided to you. This is calculations. We're just dealing with retained earnings. Now, when you get this opening balance in 2018 and in 2019, where do you disclose it? This information is going to go through the statement of changes in equity. Here is the amount that we're talking about. 2018, 320,000, 450,000. It is the retained earnings as previously stated. It goes to the statement of changes in equity. We calculated this 450,000. This 450,000 was, we calculated it opening, and 320 we calculated here. We calculated it here. We have calculated it here. So that's where the amounts are from. All right, so that is the later part. Now let's go and deal with the key issue. I won't call it difficult, something that is challenging. And once you understand this, anything, you'll be able to deal with anything that comes. So let's come here. Additional information number 1. That additional information number 1, I think we've spent some time trying to understand what happened, what needs to happen now. How do we correct it? What was the error and how do we correct it? So this is just the summary. There's no need. I just did so that we can discuss it here. But it just summarizes everything that has happened. So what is the issue on additional information number 1? Error was discovered during the year. So what transpires that motor vehicle was depreciated excluding VAT. And by just reading that line, I can tell you that it is wrong. Why am I saying it's wrong? Because motor vehicle, when you depreciate it, the cost must include VAT. So in this case, it was depreciated excluding VAT. And my reasoning is that input VAT on motor vehicle is denied in terms of VAT Act. I've explained that. Input VAT on motor vehicles, you cannot claim input VAT when you buy a motor vehicle. It is denied in terms of the VAT Act. Therefore, what does that mean? It means that the cost of motor vehicle must include VAT. So by just reading the first 4 points here, it tells us there's an error and we need to fix that error. So now, what is the impact this in terms of our depreciation? Because we were told that motor vehicle was depreciated. Will our depreciation increase or decrease? We'll see it in the calculations, but that's what we need to determine. So what is going to happen to our asset, this motor vehicle? Is it going to increase or decrease when we try to correct this? We don't know now, but we're going to find out when we go to the calculations. Now, what is the impact on VAT? Is our VAT input going to increase or decrease? Think about it. Think about it when SARS says to you that, imagine when you do a SARS return and you send it to SARS and you list the stuff you want to claim VAT on. You list them, and one of it is motor vehicle. The moment they're going to flag it and say you cannot claim, so your return will be sent back and say, no, we cannot give you input VAT on motor vehicle because it is denied. When you read the Income Tax Act, it specifically states that. So now the question is, what is going to happen? What has transpired? If they've claimed VAT input now, what is going to happen to it? Is it going to increase or decrease? Then we'll find out as well with regard to that in our next calculations. So this is a summary of additional information number 1, and this is the key issue. This is all about what you're going to do when it comes to error. Identify what is the error, what transpires, how can we correct it, what will be the impact in the statement of profit and loss, what is the impact on the statement of financial position as well. Similar to what we did with change in accounting policy, inventory valuation. All right, let's proceed with our analysis. So this is the journals that I've tried to process. It is not required. I must state specifically it is not required, but for explanation purposes, it could be very important. So the journals that has been processed by these companies, that they bought a motor vehicle, which you all agree, right? And they've used cash. Let's say they've used cash or they bought it in credit. It doesn't matter. It's not stated. Let's assume they used cash. So in other words, their cash has decreased by 287,500. We can agree with that. Money out of their bank account, and you credit bank. If they bought it in credit, you credit money out. And because they claim input VAT, because when they were calculating depreciation, the amount didn't have VAT. So they go and disclose their vehicles at 250,000, and the difference is input VAT that they will have claimed or submitted to SARS. That debit was to credit. This is what has happened. So how do we correct this? I've indicated that you cannot claim VAT input when you buy a motor vehicle. It is denied. So in order to correct that, that means that we must go and increase our vehicle by that VAT amount, which is 37,500, and we take out VAT input to the value of 37,500. That's all I did. This is just general. This is not required, but this can assist us to understand as to what happened. So before motor vehicle, if someone is to calculate, will take 250,000 divided by 5 and you get a depreciation. That's it. But that is incorrect. So first thing first, we need to increase the motor vehicle by back to the original amount of 287,500, and we increase it by VAT input. All right. I'll come back here to additional information number 2. I want us to finish additional information number 1 and see what is the impact, right? This calculation is quite long. If you look at the solution that you're gonna get on the question bank, it won't have this. So, but what is more important here is, for me, is currently what the company did, right? And the correction. So we'll go step by step and see currently what was processed and how do we correct it. Let's start here with the current one. So this vehicle was bought on 1st April 2017, 250,000. Why 250,000? Because they indicated to us that for them to calculate depreciation, it was excluding VAT. So if you exclude VAT on that amount, you will get 250,000. How do we do that? 287,500 multiplied by 100 divided by 150 should give you 250,000. So in other words, in 2017, the depreciation recognizes 50,000. 250 divided by 5, irrespective that it has been bought in April. Remember, they say no apportionment. No apportionment. So depreciation for 2017, 50,000. We have a carrying amount at the end of 2017 to 200,000. Depreciation 2018, same principles that will apply here, still 50,000. Carrying amount 150,000. Depreciation 2019, 50,000, and carrying amount 100,000. So this is what has been processed. So now we're trying to correct it. How do we correct it? We agree that there was an error. The correct amount that I was supposed to use to determine depreciation was supposed to be 287,500, including VAT, because it's a motor vehicle. That's all, because it's a motor vehicle. So if I take 287,500 and I divide it by 5, I get to 57,500. And if you look here at this column, there's a difference of 7,500 on depreciation. There's a difference of 7,500. So what does that mean? Currently, depreciation is stated as 50,000 and depreciation was supposed to be 57,500. So we can all agree that depreciation needs to be increased by 7,500 in 2017. I hope so far we're still together. If you have any question, you're more than welcome to type it on the chat. But let me repeat this portion. Current, we spoke about it, how it was calculated, excluding VAT. But in order to correct it, the amount that we need to use to calculate depreciation must include VAT. I have explained why. If you take 287,500 divided by 5, it's going to give you 57,500. If we compare the two, currently depreciation is sitting at 50,000, but we know it's supposed to be 57,500. So the difference of 7,500 needs to be increased on our depreciation. So in other words, our depreciation is going to increase, and depreciation is an expense. When expenses increases, tax decreases and profit decreases. We spoke about this relationship. So in 2017, my depreciation is going to increase by 7,500. And once it increased by 7,500, my tax is going to decrease and my profit is going to decrease. All right, so now let's go to the carrying amount. The current carrying amount is 200,000, but the carrying amount needs to be 230,000. In other words, our carrying amount, the amount that needs to be reflected on the asset, on the motor vehicle, on the PPE, supposed to be 30,000. Needs to be increased by 30,000. I hope this part is clear. So currently, if you go to the books of this company and you go to 2017 financial year and you look at motor vehicle, you should be able to see the value of carrying amount as 200,000. But the correct one was supposed to be 230,000. In other words, we need to increase our asset, which is the motor vehicle, by 30,000. That's all we do in this calculation. This calculation, you can do it the way you understand it. Doesn't have to stick to one formula, as long as whatever you do, it makes sense, because we're more interested in here. What is happening to the depreciation? The depreciation in 27 is going to increase. What is going to happen to our assets, the motor vehicle? Is it going to increase or decrease? It's going to increase by 30,000. Why am I saying that? The correct one is supposed to be 230, but what we have is 200. Okay, so now let's proceed to 2018 and 2019. This will be easier because I've explained the principles above. The same principles above are going to apply below. So depreciation 2018, current 50,000. The correct one is supposed to be 57,500. Again, there's a difference of 7,500, and it's an increase in depreciation. So even in 2018, you should be able to see that depreciation is increasing by 7,500. What about the carrying amount of the motor vehicle? Where it stands now is 150,000, supposed to be 172,500, so 22,500. It's an increase. So we're still going to increase our asset. 2019, which is the current year, same applies for 2019. Depreciation 2019, currently 50,000, supposed to be 57,500, difference is 7.5. And the carrying amount currently is 100,000, supposed to be 115, so which means we need to increase it by 15,000. So this is the calculations. Now, when we're done with these calculations, this calculation should assist us to respond to the required statement of profit and loss, statement of changes in equity, and also disclosing the error. So I'm going to start with the note, disclosure note. Once we start with the disclosure note, then we can go to the statement of changes in equity and we can go and see the other changes. Let me go to the note. All those information that we have there, you should be able to see it here. You should be able to see it here. And remember, we are disclosing information for 31st December 2019. Remember at the beginning, I indicated that if the error has been identified in 2019, you must go and correct 2018 and 2017. We have the information. But over and above that, remember the disclosure part will say you must disclose the nature. In other words, you need to explain to us what happened. So what happened here is that motor vehicle was capitalized and incorrectly depreciated, excluding VAT. That's what happened. This is a mark on its own. So don't miss this mark when you are required to do that. So the next thing, we want to know, what is the effect on the financial statement? What is the effect? The first effect we'll look at is the statement of comprehensive income as to how will this error affect our statement of comprehensive income. Secondly, we'll look at the statement of financial position. Let's start here. All this information which is here, I've just explained it in the calculation above. We can all agree that depreciation, which is an expense, is going to increase in 2017 and in 2018. I've explained that. 7.5, 7.5. And when depreciation, which is an expense, increases, then our tax decreases. This is just the relationship. Our tax is going to decrease. And when our expenses increases, it also decreases our profit. So our profit is going to decrease as well. So let me explain again. Depreciation is an expense. When expenses increases, tax decreases. When expenses increases, at the same time the profit decreases. So it's an increase in depreciation, decrease in expense, and decrease in income. This is the relationship. All these amounts are from the calculation 7.5. That is the difference between the two depreciation, the correct one and the correct one. All these we got it from the calculations. So that's why I've indicated that number one, identifying the problem, we are halfway. Secondly, while we deal with the calculations, then we got the figures, then we can do. So all this part here, the net effect on the statement of comprehensive income, it's done. And the information is here. Here's the information. Here's the information. 2017, depreciation, 7.5. 2018, depreciation, 7.5. The amount of 7.5 is as it is. I've seen students who wants to correct 2019 when it comes to error. So when it comes to error, you need to be very careful. 2019, we're still busy with it, so you can't go and correct it. You must go and correct 2018 and 2017. I've seen a lot of students go and put information for 2018 and 2019, and as such, they lose all the marks that comes here in 2017. They lose it. All right, so now let's look at the statement of financial position. So what is happening to our motor vehicle, our asset, right? In 2017, as I've indicated, it needs to increase by 30,000, and in 2018, 22,500. Where do I get this information from? From my calculation. Yes, my calculation here. 2017, 30,000. 2018, 22,500. As I've indicated, the calculation does not necessarily need to be this, but if you can show the calculation anyhow and we can see the movement, as to say our assets, our motor value is going to increase, you're still going to get the marks. You're still going to get the marks. Here's 30,000, here's 22,500. You can see as to how they show it here. You can use this calculation to show it, but I've shown you the other ways to how do we calculate it. So follow what makes sense to you, what talks to you, doesn't matter. You're still gonna get the same marks. All right, so the most important thing is the VAT input. So VAT input needs to be reversed. Why? Because they were claiming this incorrectly. So that's it, 37,500 for both years needs to be reversed. The last part, which is very important, what is going to happen to our tax liability? What is going to happen to our tax liability? This is how I want to explain the tax liability so that it makes sense to us. So calculation number 2 is talking about depreciation, 7.5, 7.5, 7.5. This is all from the calculation number 1. It's here. 7.5, 7.5, 7.5. 7.5 in 2017, 7.5 in 2018, 7.5 in 2019. That is the difference. So here's the summary of depreciation, 7.5, and the tax expense will be the same. So if you take 7.5 multiplied by 30%, it will be the same. And the decrease in profit, which I spoke about, to still be 5,250. But I want to calculate the tax liability. I want to calculate the tax liability. Right? It's my tax liability. It's going to decrease. So in order for me to calculate tax liability, if I want to calculate the tax liability of 2018, I took 2,250 plus 2,250. It's going to give me 4,500. If I want to calculate the tax liability of 2019, I'll take 2,250, add 2,250, add another 2,250, then it will give you the amount. So let's go back to the note. Let's go back to the note. 2017 is 2,250 because there was no 2016. 2018, 2,250 plus 2,250 is going to give you accumulated, because we're dealing with the statement of financial position. It's 4.5. So now what happened to our retained earnings? Will our retained earnings increase or decrease? Think about it. What is retained earnings? what is retained earnings? Right? In order for you to calculate retained earnings, you need your closing balances, and then you add your profit for the year and you less the dividends declared or paid. That's your retained earnings. So it's like your income or the amount that the company is retaining at the end of everything else. So we want to know, will our retained earnings increase or decrease? I can tell you now that our retained earnings is going to decrease by 5,250 in 2017 and by 10,500 in 2018. This should be reflected in the statement of changes in equity. Correction of error, what we're dealing with, retained earnings is decreasing by 10.5 and 5,250. And this is very important because we put our focus in accounting in the positive and negative. If you go and calculate correction of error and you put 10.5 as a positive here, you're not going to get any mark. You get it wrong, even if you calculate correctly, because we want you to understand that there's an impact. It's decreasing. If you increase it, even if it's a correct amount, you get 0. It's like even in dividends. If you go and put dividends and you don't take it out on the statement of changes in equity, even if you put the correct figures, you don't want to get it because you're telling me that dividends is increasing. That's what you're telling me. Dividends is increasing. So here is the note with regard to the correction of error. It's everything we did in the calculation. Statement of changes in equity, we touch on it. The last part that I want to explain is how does this impact our statement of profit and loss. And that should be easy to deal with the statement of profit and loss. That should be easy because I've already explained. So look at statement of profit and loss. The only line items that is going to be affected is other operating expenses as well as income tax expense. Why am I saying that? If you go to calculation number 5, and again, I must emphasize, this calculation number 5, you can do it here on the face, you will still get the marks for calculations. So there's no formula. I just did it so that for explanation purposes. Calculation number 5, here it is, other expenses. This amount were given on the statement of profit and loss. And our correction of error, we agree that depreciation is going to increase. 7.5, 7.5. Again, correction of error of investment. Investment needs to be decreased. We spoke about investment, that investment was expense instead of capitalized. So we need to take it out. We need to take it out. That will be the last portion that I explained. So here is the movement with regard to other expenses. Here is the movement with regard to other expenses. 450,000, 500, 207,500. That's what we should be able to see when we go to the solution. That's what we need to see when we go to the solution. Then tax expense, we spoke about that. This amount is given. Correction of error, we know that depreciation is going to make that the tax expense decreases by 2,250. We saw this on the note, and the investment is going to cause the tax expense to increase by 16,200. I'll explain this. All right, so last part is the investment. I've already explained it, but I'll just explain again. Investment is an asset. It was expensed. Therefore, investment, other operating expenses will be decreased. So when you decrease expenses, your income tax is going to increase and your profit is going to decrease. Here's the relationship. Decrease in expenses increases your tax expense and increases your profit. That's why our tax expense has increased by 16,200 and our profit has increased by 37,800. And ladies and gentlemen, so that is the end of today's Class, if you have any question, more than welcome to put it on the chat. As I've indicated, the link for this recording will be sent via the class rep if there's no enough further questions. And this will conclude our changes in accounting policy and estimates. But on Wednesday, we're still going to meet and have a class again just to finalize the change in estimate. But from Wednesday, when we're done with it, the topic is done. In the coming week, we'll be looking at a new topic, which is borrowing cost. Thank you for coming through, and this concludes our class.